Good afternoon, everyone. This is Joe Bacella, webinar organizer here at Chaikin Analytics, and I'd like to welcome you to our presentation of how to zero in on winners and get the best deals, your Black Friday checklist. Presenting today is Mark and Sandy Chaikin, co-founders of Chaikin Analytics. Now, as a reminder, this webinar is being recorded, and a copy will be sent to everyone who has registered. Please submit your questions throughout the presentation using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. Now, Mark and Sandy are here to tell us about Mark's latest contribution to the financial industry, the Chaikin Power Gauge Rating, a proven 20-factor model that uniquely combines fundamentals and technicals. To get us started, here's Mark Chaikin.
Thank you, Joe, and welcome everybody, and thank you for taking time out of your holiday weekend to join us. We've combined what we think is the best of Sandy's webinars and my webinars, condensed them so we can get you out of here in about 45 minutes. But please stay on until the end because we're going to show you our best ideas or best stocks for winning trades going forward from Thanksgiving. And also we have a very special Black Friday deal on Chaikin Analytics for you. Now they call it Black Friday, but it is sunny in Philadelphia. And I've been smiling all day because this is the first time that Sandy and I have done a webinar together. And I'm really excited about it. So with that, I'd like to present my wife, Sandy Chaikin.
Mark, thank you. And Joe, thank you as well for the introduction. And thank you all for not being in the malls shopping today, but investing in your future by listening to what Mark and I have to say. All right, so why should you listen to me over the next 45 minutes or so? I just started investing in stocks in 2012 when we started with the Chaikin Analytics platform. And since I started investing, I've been beating the S&P each year. And since the research shows that 4 out of 5 pros underperform the S&P each year, then by correlation, I'm also beating 80% of the professional investors. So how did I do that? Well, I started, as I say, in 2012. I started investing in stocks that I knew of, like eBay, Yahoo, Southwest Air. And those were great and had some really significant increases, triple-digit increases. Then I got into some of the little-known winners, the smaller cap stocks in 2016, stocks you've probably never heard of, like Centa, Quad Graphics, and NACO Industries, all of which were up triple digits again. And this year I've been in stocks such as Cigna, Lam Research, and DR Horton. So I do this all on 10 to 15 minutes a day. I say we're now in a time-starved economy. Nobody has enough time in the day to do what they want. So we have to be really efficient with our investing time. And I'm going to show you how I do that as well. So the examples I'm going to be using today are from my portfolio. They're stocks that I currently own or have owned. And I will walk you through how I knew to buy them, when to buy them, and how I knew when to sell them. Okay, so a little bit about me before we get started. Up through the 2008 and 09 financial meltdown, I was investing in mutual funds, first through the companies I worked for, Elizabeth Arden, the Franklin Mint, L'Oreal. And then as the fund grew and got to be a little bit more than I thought I could handle because I was not a professional, I thought, well, I'm going to turn this over to a professional. Having always been taught that if you need say accounting or tax advice, you go to an accountant. If you need legal advice, you go to a lawyer, etc. So on the advice of a friend, I engaged a wealth manager in I think it was early 2007, and he sold the mutual funds that were in my 401k and put me into 8 or 10 mutual funds of his choice. And those were okay for a while up until 2008. But in 2008, as we all know, the stock market had a financial meltdown, and so did my fund. And despite repeated calls to the wealth manager, he always advised me to hold, not sell, that they would all come back. And seeing as he was the professional, I thought, well, gee, he knows more than I do, so I guess I better hold on. Lacking the confidence to override his decision, my portfolio ended up in the spring of 2009 down over 40%, almost 50% actually. And so that was really a kind of a watershed moment for me. And at that moment, I said, boy, I have got to learn how to control my own financial portfolio and manage my future, because there is, as I say, there is nobody who cares more about your money than you do. So that became really a point in my life where I said, after I kind of overcame the anguish and the disappointment and the anger, I became resolved to take control of my financial future. And this is what I support in all of the webinars and presentations I give. For both men and women, it's really important that we manage our own financial future. Because regardless of who you are, you need to take a seat at the table. And if you're using a wealth manager, that's great, but you also need to have your own independent research and be part of the conversation. So it was at this point that, I said to Mark, yikes, Wall Street is really scary to me. There must be a better way to manage my money, but I know that I'm not going to be giving it back to a professional, at least in the short term, because of my lack of confidence. So I said to Mark, gosh, there's got to be a better way to do this. And that's when Mark came out of retirement. And maybe, Mark, you want to speak to your background here. Mark, you're on mute.
This really was a watershed moment for me. I had been known for my technical analysis indicators for over 40 years. But I said to Sandy, there is a better way, and I'm going to come out of retirement, and we're going to form a firm, Chaikin Analytics, and I'm going to fulfill my life's dream, which is to create a predictive model that goes way beyond technical analysis, that looks at the factors that fundamental investors who have been successful use every day. So these were clients or colleagues of mine. We had an institutional brokerage firm in the late 80s that we sold to Reuters. And I set out in a one-year research project to create what we now call the Chaikin Power Gauge rating. It's a multi-factor model. We're going to show you what's in it. We're going to show you examples of how it works. And it is the culmination of my life's work. But what I'm really proud of is that I created the Power Gauge rating, which predicts with a high degree of accuracy which stocks are likely to go up or go down. But my wife, Sandy, has created this wonderful, simple 5-step methodology for using it. And as she said, she went from novice to knowledgeable in just a year and a half. And so this webinar is really a combination of what the Power Gauge is all about and how Sandy uses it. So I'm pretty excited for everybody to be able to share this with you. So our promise today is to show you how to find winning stocks quickly and easily, and most importantly, when to take profits.
So the 5 steps we're going to be talking about are outlined here. First, you've got to have reliable tools that you can trust. You got to know what to buy. What is the pattern to look for in a stock that you want to own? You want to buy strong stocks in strong industry groups. We will show you how to do that. And you obviously want to avoid the pitfalls, because those, what Mark calls as landmines, can really destroy your portfolio performance. And timing decisions. Whenever I give a presentation and ask what everyone's biggest challenges are in the stock market and investing in general, they always say, 70–80% always say timing, when to get in, when to get out. So we've got some clear-cut guidelines for that as well.
So I'd like to start the webinar with a question, a little bit of a poll that Joe's going to put up. Are you thinking about a bear market? Are you being influenced by some of the talking heads on CNBC? So Joe, why don't you explain the poll, please?
So pretty straightforward. How do you feel? I thought one of the easier ways to phrase this simply enough is, how do you feel about the market right now? Specifically, of course, about what you expect going forward. You know, the way that it's phrased on the page here. Are you thinking about a bear market? So take this question from that perspective. Going forward, are you thinking about a bear market? Obviously, if your outlook is bullish, you'll see the option at the top, bearish in the middle, uncertain, perhaps down at the bottom. We'll give you about 10 more seconds, and we'll take a look at the results after that. Looks like a lot of you have already responded, though, so thank you very much in advance. And we'll call it there. Let's take a look at the results. And pretty consistent with what we've seen lately, Mark.
It is. 50% of you are bullish, 41% uncertain, only 10% bearish, which tells me that some of you may be reading my market letter, because as you'll see, we don't think we're anywhere near a bear market. Although what we found in doing this poll, we have one partner, highly respected macro economic newsletters, very bearish, has been for 6 months. And when we did this poll with his audience, 50% were bearish. So what does that tell us? It tells us that we're very influenced by the people that we listen to and respect. So it's important to either listen to the right people or have your own tools to do this. So let's take a look at the market. And when I look at the market, I look at the SPY, the Select Spider Sector ETF. This is a one-year chart from Chaikin Analytics. And as you can see, we've been in a steep uptrend. We're banging up over 2,600, which is my minimum expectation to year end. Still think there's a high probability we'll get to 2,650. And part of the reason is Chaikin money flow. Now, I think many of you are familiar with Chaikin money flow. If you are, please type a big CMF in the chat box. Because it's on every one of your online brokerage platforms. And I created this in 1982. It's been in the public domain. We've worked with institutions to show them how to use this in their daily decision making. And what you're seeing here is big mounds of green, typically Chaikin money flow, which looks back over 21 days of buying and selling, fluctuates between red and green as stocks fluctuate from overbought to oversold on a short-term basis. When it stays green like this for extended periods of time, it's telling you that institutions who use the SPY to get instant equity exposure are buying the dips. They're not concerned about a bear market. They just want equity exposure. Now, at the bottom, you'll see that the power gauge rating is gray. That's all going to change in January because we're going to have power gauge ratings for ETFs that combine fundamentals and technicals. Now, before I get off this slide, I want you to focus on that big red caution sign back in March of 2017. The S&P was around 2360. It's now 2600. That feels like a 10% rally to me. But people were looking for, as we'll see in the next slide, bear market or a big pullback or the end of the Trump rally. But the real fact is that economic downturns precede recessions, and every bear market since 1960, except for the short but painful bear market of 1987, has been preceded by or accompanied by a recession. So here are two economic indicators that have reliably predicted recessions. They've turned down ahead of every recession, and they make a lot of sense. The first one is housing starts. The 12-month moving average of housing starts has turned down before every recession since 1960. And at the right is a headline from just a week ago: new residential housing starts up 13% in October. And then under that is the ratio of leading to coincident indicators. Sandy, I think you need to mute yourself when you're not talking because we're hearing your mic. Thank you. So leading indicators are reported by the Conference Board. They were just reported last week. They're making a new high for this bull market. So the bottom line from this chart is you need an economic downturn to get a recession, and recessions accompany bear markets. There's nothing in sight to suggest any of that. So therefore, we've remained bullish on the market. And what I'd like you to do is to ignore the headlines. I know Sandy ignores the headlines because she's become independent with this 5-step methodology. The reality is earnings move markets. So here's that headline I promised you from March 31st of 2017, right when you saw that big warning sign on the chart. Caution signals are blinking for the Trump bull market. What's happened? 10% rally since then. So here are the four things that you need to know to make money in the market. You need to know the trend of the market. We showed you that the trend is up. We've actually broken above that uptrend channel. There's a very simple way to know if you're in an uptrend or a downtrend. You can define an uptrend as a series of higher highs and higher lows in the SPY. Very simple. Don't have to be complicated market technician, indicator-oriented person. The trend of corporate earnings is what drives stock prices, and we've been in a global economic expansion, and in the US, the third quarter earnings, which were just reported, showed improving earnings and also improving revenues. So we're in a very strong economy in the US. Predictions for the fourth quarter and beyond are still very strong. And it's important to zero in on the strongest sectors and industry groups. And that's one of Sandy's 5 steps, because that's where you get your best performance. And then finally, it distills down to stock selection. And we're going to focus on those last two here in the balance of the webinar. So in case I haven't convinced you that we're in an uptrend and likely to go higher by year end, here is a way that you can put on an options position to hedge a late November, December decline. If you're bearish, and I've taken a very modest view because we haven't had a 3% pullback since the election in 2016. So this comes from our options play ideas module. And what I was looking for was a way to show you how you could profit on the downside from just a 2% drop in the S&P, which is about 2,600. So the SPY is at 260. So on the right is a high probability bearish put strategy. It's called a vertical put spread. You buy the 260 put, it expires January 5th. And to reduce the cost, you sell the 255 put against that. If the market drops 2%, if I'm wrong and you put on this trade, you're going to make over a 225% profit in just 5 weeks if the market drops a mere 2%. So this is a wonderful high probability play. You could also hedge your portfolio. If you've got $250,000 in your IRA, you put on 10 of these spreads and you're protecting $250,000 for only $1,580. So it's a very, very inexpensive insurance policy for the next 6 weeks, which enables you to stay long the market and know that for the first 2% of the decline, you're protected. Now, we've covered a lot of ground here. 5 steps, technical analysis, economic indicators. When I sum all this up, I call this information overload. It's the biggest problem we have as investors because focus is the key. That's why Sandy can manage her portfolio in just 10 to 15 minutes a day, because it's all about focus. So the solution to information overload is Chaikin Analytics for both iPad and desktop. And it's our way of basically distilling everything you need to know about a stock to make an informed decision down to just one screen. Now, we've been fortunate in that some of our old institutional clients like Fidelity Investment Management, the Soros Hedge Fund, the Paulson Hedge Fund, have started using Chaikin Analytics again. They were clients of our institutional brokerage. They're using the same tools that we're describing to you today, and I know we have some subscribers on the webinar. So they're the tools that you're using, but we've also been endorsed by people like Jen Kramer and John Najarian and written up in Barron's and Forbes. Why is this important? Because I can deliver a pretty compelling webinar, so can Sandy, but we're getting proof from some of the smartest and most successful investors and traders on Wall Street.
So let's start with our step number 1, trust proven tools. As Mark says, our antidote to information overload is the Chaikin Power Gauge. You can see here it's a very simple rating. It goes from very bearish to very bullish. But what it does is it takes 20 factors. Mark tested these 20 factors for over a year. And he actually started with a universe of 200 factors and whittled it down to 20 that tested out to be the most likely to indicate the potential of a stock to out or underperform the market over the next 3 to 6 months. So it's basically like a GPS for stocks. It tells you where a stock is headed. What it does, it takes the information on the right, which even if you knew where to find it, I don't know how you would draw a conclusion from it. It builds all that into an algorithm and spits it out into what you can see on the left, which for Lam Research back in March was a very bullish rating. I've left this in here because the very bullish rating still applies today, but the stock is now at, I think it's at 217 today. It's up huge since the 127 back in March. So you can see it is a predictive evaluation of where a stock is headed. So let's put that into play with a classic bull. We call a classic bull type of stock that you want to look for when you're evaluating whether you want to buy a stock or not. You want it to have a classic bull pattern, and we'll get into that as well. But this is just a quick kind of preview of what a classic bull looks like. And you can see the ribbon along the bottom of the chart that says Chaikin Power Gauge. That's your 1 year view of the power gauge rating, which in this case has been green or bullish the entire year. You can see by the arrow way over on the left next to that little triangle, that's where I bought this stock back in late November a year ago. And I bought it with that little triangle. That's a buy signal. We have 6 pairs of buy signals and correlating sell signals that trigger when certain criteria is met within the system. And for this one, it was an oversold buy. I bought the stock back there in, well, it was November 28th, a year ago, at 138. It's now up over 200 today. So this is the type of pattern you want to be looking for when you're looking for a stock to buy. Let's get to the next slide here. So John Carter is one of our very distinguished partners, very well regarded name on Wall Street, and he has a huge following. But he likes the power gauge rating. He calls it an objective awesome meter for stocks. He says there's a lot of hyped up tools out there, but when I find something interesting, I'll let you know about it. So he likes that it includes 20 technical and fundamental factors to anticipate a stock's profit potential. And it obviously got his attention. So he says at first glance, I thought this looked like an objective awesome meter for stocks. And again, he likes that it includes fundamental and technical analysis for stock selection and the all-important issue on everyone's mind, timing. So Mark, why don't you speak to this here?
Yeah, let's look at those 20 factors that got John Carter so excited. Basically, we look at 4 primary factors: value, growth, technicals, and sentiment. Sentiment is our secret sauce. We think within each of those 4 primary factors, there are 5 sub-factors. All the weights are different. The value metrics are 35% of the model. Within value, 2 critical factors: price to sales. You don't want to pay too much for $1 of revenue. That's what's going on in Tesla right now and in the 3D printing stocks a couple of years ago. And free cash flow to market cap, because you can fake earnings with accounting techniques, but you can't fake cash flow. It's either there or it's not. And if this sounds like Warren Buffett, it should, because this is what value investors like Warren Buffett have been looking at for years. Now, I've boxed earnings surprise with an arrow toward earnings estimate revision. One of my mentors, George Douglas at Drexel Burnham in the mid-'80s, did all the original research on earnings surprise and earnings estimate revision. Now, we've just finished earnings season. We'll see it again in January. During earnings season, as you know, very volatile because companies either beat Wall Street estimates or disappoint. When they disappoint, Wall Street is very unforgiving. When they surprise to the upside, analysts start raising their estimates, and it's been documented by academics that the single biggest short-term driver of stock price movements are analyst earnings estimate revisions. So with all the noise about high-frequency trading and transparency, Wall Street hasn't changed much in the 50 years I've been in it. Company does better than expected, analysts will raise their estimates, and the reverse is true. When they disappoint, they lower their estimates, and institutional investors respond to that. So in the model, we've got value metrics, which don't change very much. I call that the bedrock of the model. Then we've got more sensitive factors like earnings surprise and estimate revision, and industry group relative strength. That's one of Sandy's 5 steps, and it's really important. And then we look at insider activity, particularly buying and short interest. Short sellers are some of the smartest people on Wall Street. That's why we think sentiment, which is 30% of the model, is our secret sauce. So 85% fundamental, 15% technical, and the most important thing, the model was locked down in September of 2010. It hasn't changed. The weights are the same and the factors are the same. And you'll see that it's actually performing in real time now in a very, very meaningful way. So let's look at performance. In 2016, which was a bull market year, we'll update this chart as soon as 17 is over. The average very bullish stock in the Russell 3000 universe up 32% in the Chaikin power gauge model. Average very bearish stock up only 9.5%. If you focus your long trades and your 401k purchases on the very bearish stocks, you're missing a lot of opportunity. On the other hand, the very bullish stocks is where you're going to get performance. Now in 2015, it was dramatic. Very bearish stocks were down over 17%. These were your energy stocks. Small caps in general were in a bear market. So it was extremely important in 2015 to avoid the very bearish stocks. These are the landmines that I like to talk about that can blow up and destroy your portfolio performance. And if you're like me, and I ask you the question, have you ever had a whole year's investment performance just get blown up because of 1 or 2 stocks where you overstayed your welcome? If you have, type a sad B in the chat box for blow up, because before I created the power gauge rating, this happened to me periodically, and it was frustrating. So I see we've got a lot of people who are or were in the same boat. Now, 2 other points of validation, and then we'll get on with the 5 steps and some very good examples. And remember, at the end, we're going to share some of our best ideas with you at a special offer, so please stay with us. We have 2 partnerships, one with NASDAQ and one with New York Life Insurance, the largest mutual insurance company in America, and their ETF unit Index IQ. So with NASDAQ in 2014, after they stress tested the Chaikin power gauge, they asked us to create 3 indices. They're called the NASDAQ Chaikin Large Cap, Small Cap, and Dividend Achiever Index. The goal was to take these indices, which are changed or reconstituted just once a year, so they're like buy and hold portfolios, even though Sandy is going to show you how she uses the power gauge in a much more proactive way. And since their inception in April of 2014, they've all significantly outperformed their benchmarks to the point that New York Life's Index IQ and Mainstay Investments subsidiary licensed all 3 of them in February of 2017 with the goal of launching those 3 ETFs based on the indices. The first one was launched, the IQ Chaikin Small Cap ETF, symbol CSML, and this is not, I repeat, not a recommendation to buy CSML. We're just using this as an example of how powerful these tools can be in a disciplined rules-based methodology. CSML was launched in May of 2016. It's got 311 million in assets. It's the most successful equity ETF launch out of 190 in 2017, and it's the 2nd best performing small cap ETF across the board of 190 small cap ETFs. The one on top there has less than 5 million in assets. We've got 311 million. The performance is there. Performance sells. Advisors are buying it for their clients. Individuals are buying it. Again, not a recommendation, just a validation of the power gauge rating.
Okay, so with that, let's look at what you're going to buy. And this is really the checklist for what you want to make sure is part of a stock that you're considering buying. You want the power gauge rating, obviously, to be bullish. I prefer it to be bullish for at least several 2 to 3 months at a time. Relative strength, you want to be strong, and money flow, as Mark alluded to earlier, you also want to be strong. And let's look at some of the examples of that. Put them right in play. Okay, so here's a great example of a classic bull, Applied Materials, AMAT. So in order to buy this, and I bought this back where this yellow arrow is back in March, and let's look through that checklist. Okay, so power gauge rating is green. It was green since late 2016, so check that off. Relative strength is strong. This is like a heat map that's up here, relative strength versus SPY. This shows you how strong this stock is relative to the S&P 500. And most investors measure their progress against the S&P 500, and that's exactly what this does. If you're not buying a stock that outperforms the S&P 500, you might as well just go with an average fund, a mutual fund, or an ETF in the S&P 500, which has grown over the last 20, 30 years at an average of 10% a year. So that's not bad. But if you want to find the Lamb Researches or the AMATs or the DR Hortons, this is what you're going to look for. So you obviously want that outperforming. We'll discuss this overbought, oversold a little bit later. That helps with timing. But here's the money flow. This is this institutional buying and selling, which Mark said he created back in 1992, and this is now on every charting package basically worldwide. So this big chunk of green here is telling you that institutions are buying. And institutions buy in such large numbers and sell in such large numbers that they can move the price. So if I'm going to be buying a stock, I want them on my side. And you can see here in March how everything lined up. Everything was green. So that checklist was checked off. And on top of that, I had this little triangle here, which shows this is a money flow buy signal. So what I like to do is look at that buy signal in addition to these other three things and look over the past, and which is what I did at the time, but I don't have that chart going back that far right here. But you look at the past and see if that was a good signal. And actually looking forward, you can see up here in early November, it triggered again a money flow buy signal. And looking at this past one, I would say, yeah, that gave me the right go ahead to say, hey, this is a good time to look at buying this stock. So that's exactly what I did. I bought this stock at 38, and it's now, you can see here, it's now up to 58. So that's a very nice, nice run. Let's look at another classic bull. This is DR Horton. Again, a very bullish stock right now. You can see that in the upper left-hand corner of the screen. And you can see how it correlates to pretty much a solid green since June with a couple of little ticks to neutral, nothing to be alarmed about. Also, since, gosh, going back to May, you can see relative strength. This stock has been outperforming the S&P 500. And for the most part, there's been money coming into this stock. And you can see what happens way back in like January, February, when you start getting that power gauge rating switching to positive, you get relative strength kicking in, and you get money. And look what happens to the price. It goes from like, that's about what, 30 or so back here in February, March, all the way up to 50, which is what it is today. So again, I used a buy signal. This happened as well to be a money flow buy signal at this first arrow here to buy this stock. And you can see here that was a good decision, right? And I could look back and see that June money flow buy signal also gave me a good, it was reliable, in other words. So I could depend on it back here when I bought this stock in August of this year at 36. So it's now up over 40% of when I bought it. And how did I know to even get this on my watch list to begin with? I keep 2 lists, and this is how I manage my account in 10 to 15 minutes a day. I have 2 lists. One, stocks I own, and I typically own 8 or 10 at any given time. And the second list is stocks that I'm watching. So I had this on my watch list. And then when I got that signal, it was like, oh, everything's lined up, everything's green, good time to buy this stock, and I did. There's a couple of other ways to know when to buy. And one of them is stock of the week, which Mark puts out every Sunday in his market commentary. He alluded to the fact that our subscribers get a market commentary from him. That's a really inclusive overview of what's happened in the market, where he sees it headed, and he has specific buy and sell ideas. And he always zeroes in on 1 or 2 what he calls stocks of the week, where he really goes into an in-depth analysis of a stock. Now, in this case, he came out with this in September 24th, and I had already bought this stock in August 8th. So it can, sometimes I give him the ideas and he goes, oh, wow, that's a great stock. Let me look deeper into that. And that's obviously confirmation that I made a good choice. Other times he identifies the stock and I just go along with what he suggests and looking at the classic bull pattern, seeing if it all lines up. And if it does, I go ahead with it. So there's a couple of ways to do it. But how do we find those ideas in the first place? And I'll let Mark here speak to how he finds them, and then I'll show you how I find them as well.
Now, I use our stock screener because I want to narrow the universe down. So for a webinar that I gave on May 24th, exactly 6 months ago, I screened for that classic bull pattern that Sandy just described, starting with the Russell 3000, and I was looking for stocks that had a very bullish rating. And I added just one factor because I had the money flow and the relative strength, high and large and mid-cap stocks, earnings surprise. That's why I highlighted it when I was describing the factors. I wanted stocks back then that had a history of positive earnings surprises because they tend to repeat over and over again. So applying those criteria in literally 3 seconds, I was able to narrow the Russell 3000 universe down to 13 stocks, including Cigna, which at that point was already moving up. It was 162, but it was on its way to 200 plus. And 6 months later, those 13 classic bulls are up an average of 17.4%. The S&P 500 up 6.8%. This is the kind of outperformance that Sandy's been talking about. If you can zero in on the classic bulls, and this is obviously a way to find them quickly, you've got everything on your side, and you have the possibility and the probability of outperforming the market.
Okay, great. So in addition to using that screener and the classic bull pattern, you want to buy strong stocks in strong industry groups. And Zacks has put every stock kind of bucketed into one of 64 industry groups. And then what we do is we rank them from strong to weak based on the proportion of bullish power gauge rated stocks in any given industry group. So you can see here back in, this was when I did this in May, aerospace and defense was the #1 industry group. These tend not to move a whole lot around in a few months' time, but you can see also we rank them, from high to low. Banks, major banks, insurance. I mean, these have all been very strong industry groups for the year. Utilities, construction. That's where D.R. Horton was in construction. And the research shows that 50% of a price move can be attributed to the industry group it's in. So what you want to do is find strong stocks in strong industry groups. I mean, that makes sense, right? Well, you can search by industry group here if you're want to favor a particular industry group, like I highlighted aerospace here, or you can go the easy route, which is what I do, and use the screener, because the screener is only going to pick the top 20% industry groups if you use a stock in universe of strongest industry groups. So you can see it takes a universe of 5,000 stocks, and immediately by saying, look, I don't want to look at 5,000 stocks. I only want to look at stocks that are in the strongest industry groups, which at the time back late October was 896. So it immediately limits the field for me, which is great. I can't look through 5,000 stocks. That would be ridiculous. Then I put in the other components of a classic bull. Remember what we just went over in step 2, which was a strong power gauge rating, strong money flow, strong relative strength. And then when we were in earnings season, which we were in the height of when I did this back in October of 26, I put in earnings surprise, which Mark highlighted earlier, and earnings consistency, because I want stocks that are going to be outperforming their industry, their analyst estimates, and outperforming. So you can see from here, I started with a universe of 5,000, and literally in seconds, I got it down to 7. Pretty amazing, right? One of those was HII. This is an aerospace, which at the time was the #1 stock, #1 industry group, excuse me. So let's drill down on that, okay? So I've taken a screenshot here of HII. This is a recent screenshot right here. You can see right now the power gauge rating is bullish. And within the workstation, you can drill down on any of those 4 components. So I'm drilling down on earnings because we were going into earnings season. And the stock was reporting earnings, as you can see here by that spike. That's when, and the EPS, that means they reported earnings. So what I knew back on October 27th was up to here, up to that yellow arrow. So I'm looking at earnings surprise was really positive. Earning consistency was very bullish. My classic bull pattern was all set up for me. Strong power gauge rating, strong relative strength, and look at all that money coming in. And here's where overbought, oversold comes into play, because this tracks kind of the zigging and zagging of a stock price. A stock doesn't go straight up or straight down. Obviously, I call it zigzags. And this helps identify that. And what you want to do is you want to buy it when it's zigzagging down, like Mark refers to buying on dips. This is what he means. You want this overbought, oversold to be dipping down. Correlates to a pullback in price. You want to sell it when it's up here, which you can see correlates to this peak here and this overbought condition. So timing. It's everyone's biggest challenge. Use this overbought, oversold indicator right here to help you gauge when to buy and when to sell. So again, from that screener, I could see that HII was on it, and it also signaled a buy signal right here with this yellow triangle. So, and I also knew they were coming up in a few weeks to report earnings. This chart, breaking down the power gauge ratings, told me it was likely that they were going to beat the analysts' earnings, and lo and behold, they did. So you can see here at this huge spike here, the stock spiked up 8 or 10% when they reported, and that's where I took my profit and said, thanks very much, I'm out of here. And the stock has since pulled back to about where I bought it, 231. So you can go from 231 to 251 very quickly, take your 10% profit, and then be on your way and find another stock to invest in. That's how I use the screener. So Mark, maybe you want to come back in here how you use the industry groups.
Oh, yeah, and I'd like to focus on the bearish industry groups, because these are the stocks and the groups you want to avoid. But I'd like to point out that Sandy has showed you 2 different styles. On Cigna, She bought it and she's held it for over a year. Why? Because the stock has been consistently moving up in a slow and steady way with the power gauge bullish and relative strength bullish. With this aerospace stock, when she saw that big spike, she said, well, that's a gift from the gods. Let me take it. So you can use this as a trader, a swing trader, or an options trader, but it's also good for your 401k and for intermediate to longer term investors. So this is a different view of that list view that Sandy showed you with aerospace on top. We're looking at the bearish groups right now. Right at the bottom, oil and gas, production and pipeline, soaps and cosmetics, consumer, miscellaneous staples. That's been a terrible group. Consumer staples has really underperformed the market. Excuse me one second. So every week in my weekly market insights, we end up with 3 strong and 3 weak industry groups, and then 3 stocks within those groups with either a bullish or a bearish power gauge rating. So right here in that same March period when Sandy found Huntington Ingalls, the 3 weakest groups were soaps and cosmetics, consumer staples, and oil and gas, production and pipeline. Exactly the same 3 that are weak right now. And within consumer miscellaneous staples, Newell Brands, they've been very acquisitive. There are a lot of brands in there that you know, like Goody Products, makes hair products. The stock was 40 and 0.37. And here's what happened. We had a sell signal. A couple of weeks later, negative earnings surprise. The stock gapped down 26% that day to a new 52-week low. This is what you can do for yourself when you avoid weak stocks and weak industry groups. You take away the pain points, the landmines that can really destroy not just your portfolio, but your confidence and cause you to lose sleep at night. Because once a stock gaps down like that, whatever you do is going to be wrong. If you sell it, the stock's going to turn right around and go back up. How many of you have experienced that? And if you don't sell it, it does just what Newell did. It keeps going down. So the key is to get out of these stocks before this happens. And here was our overbought sell signal. That only happens in a stock with a bearish rating. All our signals are filtered by either relative strength or the power gauge. Again, that puts the wind at your back. Negative earnings surprise, you don't care, you're out of the stock, or maybe if you're an options trader, bought a put option on it. So very powerful technique. And the reason it's important, Sandy, I know this is your favorite slide, so I'll let you come back in on this one.
Okay. Okay, Cheryl actually gave this to us before we had the screener. But she said she's an individual investor. There's not enough time, which speaks to my whole, time-starved economy that I believe we're in. There's not enough time to do the work Chaikin puts before me in minutes. I am wowed. And I know Cheryl, who's still a subscriber, is even more wowed now that we have the screener that is even more efficient. Okay, so how do you find those bearish stocks that Mark just showed you? He showed you the pattern from the industry group selection, how you identify those industry groups that are very bearish. And then here is the classic bearish layout for a stock. And it's basically the exact reverse of what we saw with the classic bull. So power gauge rating is bearish, as you can see here for Under Armour. Been bearish for over the year. Relative strength, this heat map here is as red as it could be. That's underperforming the S&P. And look at these strong chunks of money, particularly recently, just pouring out of this money. And then look what happens to the price. It's so predictive. And you get these little sell signals along the way. So, Mark, I don't get to have to own bearish stocks. So I cannot use examples from my own portfolio because I'm out of these stocks long before they turn bearish. So if you could speak to these examples, that would be great.
Well, the Under Armour is the classic bear. And the interesting thing is, in the 4 years we've been doing webinars, we've only had 5 classic bearish stocks because they tend to persist for so long. So way back when it was Wynn Resorts, then it was Kinder Morgan, then it was Chipotle, now it's Under Armour. Power gauge rating turned bearish on Under Armour off the charts. That's a Jim Cramer segment where he often speaks about Chaikin money flow at $40. Institutions loved it, the hedge funds loved it, the brokerage firms loved it. It's now a fallen angel. It's gone from a large cap stock to a mid cap, could be heading towards small cap territory. But for the last 15 months, the power gauge rating at the bottom of the chart has been bearish. We call that your directional edge. And then relative strength to the market has been weak. So as Sandy said, the institutions don't want to own these stocks. They get paid on outperformance, and they lose assets if they underperform. So we like the market to agree with the model on both the upside and the downside. If you are in a stock based on fundamental research, whether it's the power gauge or value line or the brokerage firm you're following, and the market doesn't agree with you, at best, that's dead money. At worst, it's a disaster like Under Armour, where the institutions have been selling and you've had a series of negative earnings surprises. Now, at a conference that I spoke at 3 weeks ago in New York that Jim Cramer sponsored, a paid conference at the Harvard Club, which he called a teach-in. I was the featured speaker, and you're seeing a lot of the same presentation I gave then. And one of the things I said there was that you don't want to bottom fish. Bottom fishing is the most expensive sport in America. And here's an example of that. When Under Armour was trading at 20, everybody on CNBC was saying 18 to 20, triple bottom, time to buy it. Bearish earnings surprise wiped out that argument. Then it rallied up. You got relative strength sell signals. These are really good for swing trading. They last 4 to 8 weeks with a 70% accuracy, and they're simple. How do you get a relative strength sell signal? The stock is underperforming the market, and you know that because our heat map is red. It goes above its 21-day average and drops back below it. That triggers the relative strength sell signal. Really powerful technique for swing traders and options traders. And yet again, after the Cramer conference, with the stock seemingly have triple bottom at 16, a negative earnings surprise, and all the way down to 11. So bottom fishing is dangerous for your health. Occasionally, if you're lucky, you'll catch a bottom and feel really good about it, but then you look back at all the times that you didn't, and you realize that it's a very costly sport. Now, Sandy showed you the D.R. Horton recommendation, a home builder, a bullish recommendation on 924. She had already bought the stock. It's moved from 36.90 when I recommended it to 49.50, $50. It's the bone of contention here because I suggested that maybe she should take some profits, and she did it around the 44, 45 level, and here it is 10% higher. So I'm backing out of the advice business because Sandy does it as well or better than I do. But 2 weeks earlier, I had put out a short recommendation. My stock of the week was bearish, Allergan Pharmaceutical. It was 233.55. It's dropped under 170. And here's why I put out that recommendation. I want you to look over my shoulder. The stock had a bearish rating, was underperforming the market. Look at all the institutional selling here. Now, the stock rallied up and triggered an overbought sell signal. That's a new 8-day high with a bearish rating. And that's when I put out that sell recommendation. Now, why did it rally from 215 all the way to 235? Because they have a great drug called Restasis. It's a dry eye treatment that Sandy actually uses. And they were under patent suit by the generic drug stocks like Teva and Mylan, who wanted to come out with a generic version. So Allergan came up with this ploy that I just shook my head at. They sold the patent rights to Restasis to a Mohawk Indian tribe in upstate New York under the theory that an Indian tribe is a sovereign nation and can't be sued, so they could protect themselves. Well, that didn't sound very compelling to me. So I put out the short sale recommendation. The stock was 233. As you can see, it dropped to under 170. And by the way, they lost the lawsuit and then came out with a negative earnings surprise. So there's another example of the classic bear. In real time, we recommended it, and these are the stocks you really need to avoid, or if you're an options trader, great put option candidate. Now, there's one pattern I want to highlight. Sandy has already referred to it when she looked at one of the stocks. We call it the personality change. And I think it's the key to making and keeping profits. You've got to be able to spot personality changes. And we define a personality change as a stock that's been outperforming the market that begins to underperform, or a stock that's been underperforming that begins to outperform. The reason this pattern is so key is that on Wall Street, people put their feet in cement, not just individual investors, but institutional investors and analysts particularly. So one of the ways to avoid putting your feet in cement is to know when a stock that's been doing well starts to do poorly. And here's a real-time example of a stock we're very bearish on, Tesla. Had been outperforming the market. Notice that the power gauge was yellow or neutral because the fundamentals on this company are just hideous. You may love the car, so if you love the car, drive it, but sell the stock. And you've had these overbought sell signals, and this is a stock where everything is bearish. The power gauge is bearish, underperforming the market. Institutions are not buying this, they're selling it. How do we know that? Chaikin money flow has been red for 2 months. So this is your classic Chaikin bear, but recognizing that personality change, if you are in love with Tesla, gives you the opportunity to sell the stock in the same way that when it went from underperforming to outperforming back here in January, even though the fundamentals weren't good, if you're a momentum trader, you could have bought the stock at 240, 250 on the way to 380. That's fine. Just be realistic. Know that you're on a high wire without a safety net. So you want to have a way to get out, and this personality change is a way to let you know that the picture has changed. Now, back in 2016, when SunEdison was the darling of the hedge funds and the solar energy business, and Merrill Lynch had a buy rating on it at 28 to 30, same pattern. A stock that everybody loved with very poor fundamentals, because the power gauge was bearish, it told us that, had a bearish personality change. The stock was trading around 26, but the institutions had already been selling it, and they continued to sell it from June of 2015 through April of 2016. This chart ends in April of 16. Why? Because the company filed for bankruptcy. So it's an extreme example of how a bearish personality change and a bearish power gauge can get you out of a high-flying stock that's about to become a fallen angel. Now, Merrill Lynch did put out a sell recommendation on it. They did it in February at $3 a share. So analysts can put their feet in cement as well. That's why you need independent tools, if you're following brokerage firm research, to monitor what's going on in your portfolio. Now, we got this testimonial from a Merrill Lynch advisor who saw this presentation back in May of 16 at an option show in California. He said, I bought SunEdison at 15. If I had only had Chaikin, I could have saved myself and my clients a lot of money and pain, because Merrill Lynch was still recommending it on the way down. That's a classic example of the analyst putting his feet in cement. It's not meant to be a knock on Merrill Lynch. This happens on every firm on Wall Street in the 50 years I've been in the business. Analysts fall in love with their stocks just like you and I do. So everything we've been talking about up to now, we call the ideal setup. Power gauge, relative strength, money flow. Industry group strong. Warren Buffett calls it the fat pitch. He's famously said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. We call it the ideal setup. Now, the missing piece is something that is the fifth step in Sandy's five-step process.
Okay, thanks, Mark. So a couple of things based on what Mark just said. You don't have to know everything that Mark knows. He's been on Wall Street 50 years. He has a brain that remembers everything, every little detail about everything. You don't need to know that. You don't need to know that Allergan had sold that patent to an Indian tribe in Connecticut. All you have to do is know how to read these charts and identify a bull versus a bear, and identify the pattern so you know when a stock is likely to outperform and when it's on the brink of underperforming. One of the things that helps me with that are these buy signals and sell signals. And we've alluded to them in the charts that we've been showing you. And also the overbought, oversold indicator. That's the one that identifies that zigzag pattern, as I call it. So let's look at a couple of examples, because how do you know when you get a buy signal? Well, we call that an alert. And what we have for any list, and I've overlaid it here on my watch list, is you can overlay that alert view on any list, and it'll immediately pop up any signals, as you can see here, which I did back in September, any signals that have triggered, as well as other things that may affect the price, like a power gauge alert or an analyst estimate revision. I mean, these are things that you want to know about, but you don't want to go looking for them on every stock in your portfolio and every stock on your watch list. That would just be way too cumbersome. So I use this as an example because I bought this stock, Beazer Homes, on this alert that I got back in September when I was preparing for a webinar. So you can see the stock here was 15. You can see that it's in the construction and building services, and from that industry group list, we know that was the number 8 or number 10 industry group, and has remained strong. So let's drill down and look at the chart for Beazer Homes. Well, this yellow arrow is that signal, that buy signal back here, which is where I bought the stock, a relative strength buy signal. And you can see here everything else lined up. I mean, the signal only tells you what's pertinent to that particular signal. It doesn't know if the stock has a power gauge rating that's neutral or bullish, or whether it's overbought or oversold. It's looking at certain criteria that Mark put in the algorithm to trigger that particular signal. So I look at the rest on the chart. I see that it's been strong power gauge really since April. Relative strength's been outperforming since August, and look at all this big money flow coming into the stock. So that gave me the confidence to buy this stock. It also was at this oversold condition. You can see here this dipping down. You want to buy it when it dips down. You want to sell it up top here. So you can see this stock has had a really nice run, you know, and it's still at, I think it's 22 or so today. So I'm still in this stock. It reached actually a 52-week high today, and I'm holding it. Let's look at my alerts list on the same watch list a month later, late October. And that's where I got this money flow buy for HII, which I showed you earlier in the industry group section. So there was that money flow buy signals telling me, hey, you can get it. You can find these signals two ways. This way you find it on the watch list. And as I showed you before, I bought that stock, and that turned out to be a really good pop 10 days later or so when I sold it on the earnings spike. So Mark, let's look at your dashboard and how you find these alerts.
Now, this is the alerts dashboard from our iPad app. We're looking at a list called My Stocks. So everybody in Chaikin Analytics, every subscriber has their own list or multiple lists. And so back for a webinar I did on August 10th, Bed Bath & Beyond had given a relative strength sell signal. There were buy signals on stocks that we liked back then, like Boeing, which Sandy actually bought, Michael Kors. But let's look at Bed Bath & Beyond. The red arrow is where that sell signal happened. That's your relative strength sell signal, underperforming the market, goes above its 21-day average, drops below. These signals persist for 4 to 8 weeks. And that signal came in the middle of 2 earnings reports. And each of those earnings reports, which turned out to be negative earnings surprises, that's why earnings surprise is one of the important factors in the 20-factor model, was preceded by a relative strength sell signal. All of these have worked out beautifully, and this is an example of trading with a disciplined methodology that leads to better profits, better consistency, and it's a heck of a lot better than trading on your emotions, which is the message that we've been preaching for the last 4 years. Discipline trumps emotions every time.
Okay, so this is the section that I think has the most relevance to most investors, because this is where, you know, timing comes into play. How do you know when to buy and when to sell? Well, we've been showing you the little triangles, the alerts, the signals along the way, which are what I usually go by when I decide to buy a stock. It's 80–90% of the time it is along with a buy signal. But when do you know when to sell? That seems to be the hardest question to answer. And I know our customer support team says this is the question they get most often. So I've broken it down into two different segments. When you take a profit or when you sense a stock is breaking down. So when you take a profit, these are the characteristics to look for. The price hits that upper volatility band. The price is overbought. That's the zigging and the zagging. Or it spikes up after a strong earnings report, as I just showed you on like HII. But let's look at some examples on that. I should preempt this by saying that I usually don't tell Mark what stocks I own because, like he did with D.R. Horton, then he gives me advice on what to do with them. So I usually he doesn't know. He knew about D.R. Horton because it was his stock of the week. And I told him I already owned it. But nevertheless, the rest of these decisions are really mine, and I kind of keep them to myself. So Lamb Research, we've been showing you this. I think we showed this in the beginning, or we referenced it in the beginning when we were looking at that power gauge rating. This chart goes back actually to late March when I gave a presentation, and I used it as an example of when to sell. On those when to sell rules, the first one was it hits this upper volatility band, and this is this little zigzag thing up here. There's a zigzag at the top, one kind of in the middle, and one at the bottom. And this is basically what I think of as a channel. I'm a sailor. So if I go outside of the channel, I'm apt to run aground. And I use that same analogy here. This is typically the range of price that this stock falls within. And when it hits this upper band, it tends not to stay up there. It tends to pull back. So that's one thing to look for when to sell, and that's actually what I did with Lamb Research. I bought it, you can see on this money flow buy signal here in March, late March, and then it jumped up 9%. It went up to that upper volatility band, hit a 52-week high, as you can see here, and I thought, oh, this is cool. I'll just take my 9% profit and sell, which I did at 127. And you can see here, this overbought, oversold is dipping down. Oh, right, I'm sorry, up here. Excuse me, it's dipping down when I bought it. It's peaking up when I sold it. So that, again, is a great help in timing. But then the stock kept going up. I thought, oh, damn, I think I want to get back into this stock. It went sideways for a while. And then I saw that it was coming up on earnings. And I knew from that earnings drop-down component on the power gauge rating that had strong earnings performance, earnings estimates, strong consistency, all looked good. So everything pointed to an earnings beat. So I said, I'm going to get back into the stock before they report. And I bought it like $1 less than what I sold it right before, the day before they reported earnings. It did beat analyst estimate. It spiked up 10% to 140. Again, went above that upper volatility band, and I thought, oh, this is cool. I'll take another 10% profit 3 days later. So I did. But now look what's happened. Now you see all this money coming in, strong, power gauge persists, strong money flow. So let's go to the next slide. I bought it again. So I'm saying, boy, I don't know that I should be out of this stock because this is still a classic bull. It's still one of the strongest stocks. Look at the money flow coming in. Look at everything lining up. And because it was back on my watch list and I got this money flow buy signal here in May, I bought it again at, I think it was 140. So it's now up to 217. I think it hit an all-time high today. And now I'm just happy to hold it and have it in my portfolio. And this is how you can use these indicators and these, bands, volatility bands to help identify when to buy and sell. So that's our biggest challenge. The other timing when to sell is if you sense something a stock is breaking down. Well, how do you know that it's breaking down? Well, typically if the power gauge turns neutral and another indicator turns negative, like money flow, that gives me a pause. It gives me an alert, basically. Hey, you might start watching this stock a little more carefully because it might be breaking down. Certainly if you get a sell signal, although for me, I never get to that point because I'm out of these stocks usually way before they trigger a sell signal. If the price drops below that orange line, which is a proprietary long-term trend line, or that lower volatility band, which is what I use, call as the signal markers. So the classic example I have for when I sense a breakdown, this actually includes taking the profit and sensing a breakdown. It's kind of a combo sell here of when to sell. But you can see by this yellow arrow, and this is from the iPad app. The iPad app has a slightly different configuration of stocks, but what was happening when we were showing this from the desktop version, you couldn't really see the upper volatility band because of this breakout buy signal up here. So we took a different shot here. But this was on my screener, so I had been watching this last fall. In December 6th, actually, I got this buy signal here to buy this at $16, excuse me. Note now this stock is at $6.40. So I bought this stock at $16, watched it go up. It hit this up volatility band, but I circled this because look what happened here. The money flow was just turning negative, and the power gauge was just turning neutral. So I said, wow, when these things converge, particularly if a price hits an upper volatility band or an all-time high and money flow starts to go away from it, that definitely is an alert to get rid of this stock, which is exactly what I did. I said, wow, I'm going to just take this nice profit, 17% profit. I sold it at 19 at the top at the all-time high. And 2 days later, they pre-reported, which is really weird. And that's why you see this 10% drop right here. They pre-reported before February 15th when they reported again, and it was down another 10%. And you can see what's happened. The stock has just done nothing but go down. It's now 640. It's dropped 66% from when I sold it. And how would you like to have bought a stock at 16 and watch it go down to 6? Not pretty, right? But these are the signals. This is what to look for, this classic pattern here of when a stock starts to break down, and also when you can take your profit because it's up on that upper volatility band. So let's recap. We walked through 5 steps to winning stocks. Trust the tools, that's the power gauge rating. What to buy, that's the classic bull. You want to buy strong stocks and strong industry groups, let the screener do the work for you. You want to avoid the pitfalls or the classic bear pattern. And of course, timing. You want to know when to get in and when to get out. And that's also that you can celebrate. I mean, what we do with my profits from my investing and trading is we not only stash some of the money towards our retirement, but we also take great vacations, thanks to these profits. We've been to Turkey, we've been to Vail, Colorado, we've been to Rome, and we're going to Florence in the spring. And this is all paid for from my checkbook because of based on the profits that we've made. So, you can do the same thing. This is not Mark telling me what to do. This is me creating this 5-step method and putting it into practice and really not letting the emotion get in the way, but let those indicators and those guidelines, as I've showed you, show the way. So yeah, Mark, you take over from here.
What I like to say is if Sandy can do it, you can do it, because as I said, she went from novice to knowledgeable in a year and a half. So we promised you a way to look for bargains with the theme of Black Friday, Cyber Monday. So let's just quickly recap what we're seeing here in the market. Strong sectors: technology, consumer discretionary, and financials. Strong industry groups: construction, building services, that's part of consumer discretionary, investment brokers and portfolio managers, chemicals, miscellaneous oil stocks, the refiners like Valero, and apparel stocks. So what are some strong stocks that you should be looking at on pullbacks as buy candidates? D.R. Horton, Beazer Homes, Affiliated Managers Group, this is an investment management firm, E-Trade, Interactive Brokers, HUN, Huntsman Chemical, NL Industries, Valero, and Michael Kors. So those are your buy candidates. Now you want to avoid the weak industry groups: airlines, oil drilling, media stocks, particularly the cable stocks like Charter Cable, and restaurants. So specific stocks to avoid based on our three-step analysis or five-step analysis: Tesla, Southwest Air, it's being negatively affected by rising oil prices; Schlumberger and the drilling group; Chipotle still hasn't found a bottom, sadly; Charter Communications and the cable group; and Under Armour, which we've already looked at. So we've been looking at Chaikin Analytics, where everything you need to know about a stock is on one screen. We won the Benziga FinTech Award for Best Ideas Platform back in May at their annual Financial Technology Awards. And Chaikin Analytics has at its core the centerpiece, this multi-factor model, the 20-factor model that combines fundamentals with technicals. It also has something called our stock discovery engine, which we haven't gotten in. So when you subscribe to Chaikin Analytics, you'll get the best ideas generator in the investment world. That's why we won the Benziga FinTech Award. And you seed it with a stock that you like, and it comes back with similar stocks.
I think this one, you seeded it with Lam Research, and it also gave you Excelis. And I happened to buy Excelis back then when it was yours. You featured it as a stock of the week. So I bought it back. It was even lower than this. It was at 18. It's now at 36. So this can be a very powerful way as well to find stock ideas. We didn't have time to go over it today, but when you subscribe, you'll immediately get into a class, a very small group class that Joe Bacella or one of his colleagues will take you through, show you how to use the stock discovery engine, how to find those buy and sell signals in the alerts view, and basically walk you through the platform so you are familiar with it.
So additional bonuses come with Chaikin Analytics. We've seen the screener, and in the beginning we showed you that put trade on the SPY from our options play module. So Chaikin Analytics is normally $2,195 for an annual subscription to both iPad and desktop. As a Black Friday special, we'd like to take $400 off the price of Chaikin Analytics, reducing it to $1,795 for a one-year subscription. You can go to chaikinanalytics.com/black or contact our sales department, sales@chaikinanalytics.com, or the phone number that's on the screen. I know Joe Bacella is going to be typing this link into the chat box. Now, I mentioned that I had spoken at Jim Cramer's conference. He live tweeted while I was giving the same presentation on the power gauge rating that we gave you today. He said, Chaikin Analytics model is the best. I used it at my old hedge fund. Great praise from a really good stock picker. And you get additional bonuses with Chaikin Analytics: our intraday chart, our earnings alerts, and my weekly market insights with the bullish or bearish stock of the week. Now, we've only included this testimonial because it's true. Ken H. on July 30th said, I've been trading options for many years without much success. On January 4th of 17, I found your system. I started with 235,000. As of today, which was July 30th, my net liquidation value is $1,205,000. Would not have been able to achieve this without your system. One of the reasons Ken H was able to do that was one-on-one coaching. Because as a subscriber to Chaikin Analytics, you get small group tutorials. That's Joe Bicella 3 days a week and mornings before the opening, a couple of days. Unlimited coaching and support, including one-on-one coaching. And my colleague John Schlitz's daily morning insights, so you know what's going on pre-opening without having to stay glued to CNBC. Now, I'd like to roll back our recent price increase for 4 days in the spirit of Black Friday and Cyber Monday. So as a Black Friday special, we'd like to reduce the price over $500 to $1,650. That's a rollback to where our pricing was just a couple of months ago. So this offer expires midnight on Cyber Monday, November 27th. Go to chaikinanalytics.com/black. I can't thank you enough for taking time out of your holiday, but more importantly, I can't thank Sandy enough for making me look good and showing you everything that you can accomplish with Chaikin Analytics to become an independent investor who has the confidence to deal with your retirement and your trading.
That's a key point I might add, is the confidence level, because if you don't have the confidence, you're not going to make good decisions, or you're going to freeze when you have to make a decision, not make a decision at all. So this system has given me the confidence as well as the tools to really manage my my money and become a really top stock picker, for lack of any other word. That's kind of what everyone says. I can really find those good stocks. So if I can do it, as Mark said, you can too. So thank you all. Mark, thank you. Joe, thank you. And in particular, I thank all of the attendees on today.
All right, everyone. Well, thank you very much, Mark, and thank you, Sandy. For access to the offer page for that Mark and Sandy are making available, I did chat out that link into the chat window. Feel free to take a look there. The discount will automatically be applied. You can go right to chaikinanalytics.com/black, or you can give us a call at 877-978-6257. We actually have another line here as well, but right on the page here, 877-978-6257. We will be back on Monday of next week for our onboard session. This is perfect for each one of you. This is how we will show you the ropes, bring you up to speed on everything within our platform, and make sure that you can be as effective as possible with the program. But until then, make sure to join on Mark and Sandy's offer here. Again, that's $1,650 for a full year to Chaikin Analytics. Again, chaikinanalytics.com/black or 877-697-6783. In the meantime, everybody, hope you've had a wonderful Thanksgiving. Enjoy the holiday season, and we will see you on Monday for the onboard session.